The guy who I have been told I look like when I'm actually having a good day. Sean Mullaney's here, like a better version of Joe Saul-Sehy. How are you, man?
I'm doing well. How are you, Joe?
I'm good, but you're
it's
all
good to hear that I'm here for my appearances. That's fantastic. That's right. I don't think I've ever been anywhere for my appearance.
I just need you to stand in for me from time to time, because I think we could look at us. We could get away with that. You are a better version of me. Like if I didn't let myself go, it'd be great.
To be fair, I'm a little younger than you are. Not a ton younger than you, but just a little younger. You remember the 80s Detroit Tigers a lot better than I do.
I do. Fair enough. Touche. I almost said cliche. I don't know where that came from. But we're not here to talk about how handsome we are. We're here to talk about tax planning. But even before we get to that, you had a big aha, like an eye-opening aha at a Camp Fi that we both went to together. We were at Camp Fi Southwest. And during your awesome presentation, by the way, just incredible presentation, you talked about the tax advantages you get through being frugal. And I got to tell you, I've thought about frugality in a lot of different ways. I've never thought about the tax win that you have from being frugal. Can you walk people through that? Because this is another reason. This is a very powerful reason to be frugal.
Yeah, it starts with the predicate that all the stuff we have in our homes, right? Almost all of it is winding up in the dumpster. Right? Your desk, your chair, your kitchen equipment. And look, there's good reasons to have it. But remember, it's all winding up in the dumpster at some point. So why should my house be a way station on the way to the dumpster for all that stuff you see at all those stores? Okay? Keep that in the back of your mind when you're thinking about that. So I thought about, hey, if I want to live on $50,000 a year versus if I want to live on $100,000 a year, just take those two archetypes. One person wants to live on $50,000 a year. The other person wants to live on $100,000 a year. For 99.9% of us, that has to come through W-2 earnings, maybe self-employment. I mean, there are trust fund people out there, but that's not most of the
audience, many,
right?
Yeah, not us.
So you got to go earn that $50,000 or that $100,000. And the first thing you're going to learn first day on the job or first paycheck is, well, you don't just get $1,000 as salary that week and take home $1,000. No. There's FICA, there's federal income tax withholding, state income tax withholding. So if I want to live on $50,000 this year, I have to go earn a lot more than $50,000. And I think the example I used for a California resident, single person, was something like $64,300 in total income, so that I would pay my taxes, FICA, California federal income tax. So I have to pay about $14,000 and change in taxes on $64,000 of income to then net the $50,000 I need to live my life. Okay, great. Well, what if I want to live on $100,000? Well, it turns out I'm going to pay a whole lot more tax, particularly my effective tax rate. So if I want to live on $100,000, I have to go earn something, I forget the exact numbers, like $150,000, because tax rates are progressive. So tax rates punish you for that extra consumption. So one of the ways to sort of arrange your life from a tax perspective in a more optimal way is consume less. Right? We say, oh, we have an income tax, and that is certainly true from a legal perspective, but because of our progressive tax rates, we actually have something a little bit akin to a consumption tax. If I want to live on $150,000 or $100,000 of consumption this year, I have now tricked myself into paying higher and higher income tax rates, which means the more I consume, the more I'm taxed. Why not be a little more modest, especially if all that stuff is ultimately winding up in the dumpster?
And that's the key, is the stuff ending up in the dumpster. And if it is, what the hell are we doing? I just love that. I did not think about it from that perspective. And it is brilliant, my friend. Now, you spend most of your time with people on their financial planning journey, but you also know a ton more you've forgotten more than I know about taxes. It's that time. You know, it used to be back in the day, people would bring in shoe boxes of stuff. Now they have electronic records all over the place. Come to people like you and me and go, hey, Sean, hey, Joe, what should we do? What can I still do? What should I be thinking about right now in the end of February to really put the puzzle together better than I could if I just wait till April 15th.
Yeah, I think there are a few things to be thinking about. One is, let's file an accurate, complete tax return. And the other is, are there still some planning opportunities out there for 2021? I like to say the best tax planning is lifetime tax planning that's done up front, but there still can be some plays in the joints for last year's tax return. I'll mention two real quick here, right? One is, did you have a high deductible health plan, and did you have an HSA, a health savings account last year that you didn't max out, that you might otherwise qualify to max out? You could still write a check to your HSA this year for last year and claim a tax deduction on your 2021 tax return. That's one play in the joints. The other one has to do with IRAs and Roth IRAs. There's still time to be doing a Roth IRA or a traditional IRA, even potentially a backdoor Roth IRA for 2021. So as you're putting all this stuff together, you want to think about those things.
Boy, the backdoor, dude, let me stop you just on the backdoor Roth, because you look at the stock market going down lately. Like, this is, if the stock market's finally giving us a few lemons, Sean, let's make some lemonade.
Well, all right. So 2 points on that, right? There's still time to do the backdoor Roth IRA for last year, right? And then the other thing you could think about now, although it's not a 2021 tax return issue, is Roth conversions, right? So if you have a traditional IRA or a 401k, and it's got some big losses in there, now could be the time to pull the trigger on a Roth conversion. So you say, all right, this investment has a low value relative to where it's been. I'm going to convert it to a Roth. I'm going to pay tax in the year 2022 on that. The downside of that is you're locking in taxable income. Now, it still might be a great play. It depends on your circumstances, particularly for the early retiree out there. It might be a good play, but it gives you less flexibility at the end of the year, because, if you convert $20,000 from a traditional IRA to a Roth IRA and that's fully taxable right now, that means when you get to the fourth quarter and you're like, oh, what are my interest, dividends, capital gains, other sources of income? Are there other things I could be doing in 2022? You already got $20,000 that's locked in. You cannot recharacterize a Roth conversion anymore. So that $20,000 is just taxable income. Doesn't mean it's not the right move for some out there in the audience. It just means you need to be careful with it.
Yeah. Yeah. You talked about it first, about the fact that you think that it's better to go in with a strategy, right? Which I fully believe. Where do you see people get that wrong? That they don't really have an overall tax strategy? What could most of the stackers out there, Sean, be doing better?
Here's where I would start. I would start with understanding the critical distinction between preparing a tax return and doing tax planning. I think people hear the term tax season, they say, oh, okay, it's tax season, it's late winter, early spring, it's time for me to do my tax planning. That's not really the way it works, right? So late winter, early spring is the time to get the records ready from last year to make sure you do a complete and accurate tax return. But that's not tax planning. There's nothing wrong with a complete and accurate tax return. Sure. We should all file one, right? But tax planning is saying, okay, I have my return and that's an important data point and I'll come back to it. But what I want to do is look at my entire lifetime and say, what are those tactics? What are those strategies I can do now to reduce my total lifetime taxation? And there it depends on where are you today and where are you trying to go to tomorrow. And for a lot of my clients and people out there, it's okay, I know where I am today. I can get my income together. I can gather that information, my balance sheet, my assets, my liabilities. But I don't really know, do I want to retire in 5 years, 10 years, 15 years? It's okay to have sort of a range of goals, but you do want to be thinking about the future and what your future might look like, and that helps inform you. That helps inform, hey, what is the best tax planning and tax tactics today in terms of limiting my overall lifetime tax liability?
I love that. It's the difference between taking a puzzle that already has pre-printed pieces, right? That's your complete and right tax form today, versus making a better puzzle.
That's right. That's exactly
completely
right.
Having a better one. Yeah, love that. Sean, we have some big news that I know that all of our stackers are going to love, and it's that finally finally, you have a new YouTube channel. It's about time.
That's right. You can find me on YouTube at Sean Mullaney. And what I'm trying to do there is little tax insights, some financial planning insights. I'm going to try to post every Saturday morning. And it's just like a little thing. Look me up, Sean Mullaney on YouTube, trying to get some knowledge out there on tax planning and personal finance.
That's so awesome. And if people want financial planning help from you that is very fire friendly, very financial independent movement friendly, how do they find you?
They can find me at two places. One is my tax and financial independence blog, FITaxGuy.com. You can also find me at my personal financial planning firm website. That is MullaneyFinancial.com.
And guess what? We're going to link to both of those, all three of those, including the YouTube channel, on our show notes page at stackingbenjamins.com and in the 201, our newsletter, stackingbenjamins.com/201 to sign up for that. Mr. Mullaney, it's about time we got you on, my friend. Thanks for hanging out and nerding out on taxes with us. I appreciate it.
Love to, Joe. Thanks so much for having me.